capital asset scheme. So, in order to understand what the capital asset scheme under the UAE VAT is, first we need to understand what a capital asset is to begin with. So, a capital asset is a line item in the balance sheet, the statement of financial position. So, it is categorized by two main characteristics. Number one, long useful life, and number two, high or large in value. Long useful life depends on whether we are talking about normal capital assets like plant or machinery and equipment. So you can say for these categories, a long useful life will be considered as 5 years. And if you're talking about real estate, then in that case, long useful life will be considered as 10 years. Now, that being said, it is important to note that two classifications, both these requirements must be met, which means that the first category, the requirement of long useful life, is useless and the asset is not a capital asset unless and until the high value requirement is met, which is 5 million dirhams and above should be the value of the asset to be considered as a capital asset. Now, that being said, what matters matters is that in most case scenarios, such high value assets with long useful life are not purchased with a single balloon lump sum, single one payment. No, that's not how it happens. Normally, you purchase these on installments. So you make a large balloon payment and then you make small payments over a certain period of time, and then you maybe make a final terminal payment. Alright. Now, in this case scenario, you are purchasing, for example, a plot, a piece of land, or you are constructing a building on the piece of land, or you are purchasing the entire building on installments, right? So this all constitutes to capital assets. And maybe we already have a building and we are talking about refurbishment of the building, reinstate the building. We talk about maybe repairs and maybe installing new equipment. So, for example, in this classroom we had a whiteboard, and now we want to upgrade and we want to have a projector in, right, to make things more digital, for example. So these case scenarios are there in case of capital assets, but the requirement is that these extensions or these fitting outs or these repairs must be done in quick succession. There cannot be a delay between the expenditures. It cannot be that in this building I will install the projector first, but the computer system requirements will be met later on. So that these will be two distinct expenses if there is a wide, for example, 1 year gap between the expenditures. And the expenditure must be combined. The value of that combined expenditure should meet this requirement of 5 million plus dirhams and long useful life to be considered under the capital asset scheme. Also, when you talk about these installations and these supplies, it may be taken from different vendors, but the gap must not be long, right? This 5 million is excluding VAT, and we're talking about taxable supplies in this case, not exempt supplies. And the items for one very important point, the items which we are considering as capital assets should not be items of stock. So there are a few things which is a requirement for items to be considered as capital assets.